Hi everyone, my name is Thomas, and today I'll walk you through why Ford is a compelling buy with a target price of $25.42, almost doubling the current price.
Ford has gone through major swings over the last decade, from COVID to different product releases and supply chain shocks. But the company's fundamentals are stronger than ever right now. Our thesis really comes down to three main buy catalysts. First, that Ford is achieving real structural margin expansion. Second, that Ford Pro is becoming a high margin commercial and software powerhouse for the company. And third, that Ford's hybrid first strategy is really aligned with consumers' demand right now and moving forward. So these catalysts all flow into our valuation model and really support the upside we see in the company. And so now moving on to our buy catalysts. First, one of Ford's biggest improvements is margin expansion. In 2024, Ford delivered the $500 million in cost reductions and plans another $1 billion this year. At the same time, quality has improved dramatically. Ford has moved up 14 JD Power spots, which has really helped them lower their warranty costs. And even after a one-time $2 billion aluminum supply shock with the fire, Ford's EBIT guidance really remains strong. And excluding that event, margins are actually at the high end of management expectations. That's why in our model, profit margins rise from 2.5% in 2023 to over 6% in 2030. This improvement is structural, not only temporary. Ford Pro has become the company's strongest business. In 2024, it generated over $66 billion in revenue and $9 billion in EBIT, showing a 13.5% margin, which is actually higher than Tesla's auto margin. And Ford Pro is also much more than just commercial vehicles. It now has over 600,000 software subscriptions, which is growing 30% year over year with a gross margin of more than 50%. Also, in our model, Ford Pro is really a major reason why revenue grows steadily and operating margins expand. It shifts Ford towards a more recurring, higher quality revenue, and it really helps the company for long term success, we believe. So, for a third and final catalyst, Ford's hybrid strategy is one of the most important drivers of the upside. Hybrids are the fastest growing propulsion type in the US, and Ford's hybrids sales have grown from 126,000 units in 2021 to a projected 270,000 units in 2025, which has shown a 14.7% CAGR. Ford also dominates the hybrid trucks industry with roughly 75% market share. And with EV demand slowing down and plug-in hybrids remaining flat, hybrids really fit in well with what the consumer wants and needs. And this improves Ford's economics in the model. Hybrids really help gross margins expand and allow capex to fall a little bit from 4.7% to about 2% of revenue in our model. And that frees up cash and reduces EV driven losses as they can test. It allows them to test different R&D in their EV without losing that much money and cash. So when we put all this into our valuation framework, the upside really becomes clear. Our DCF is built on the trends we just discussed, a steady 5 to 8% revenue growth, improving margins, and a rising free cash flow. So under those assumptions, Ford generates above 10 billion in annual free cash flow, giving us a DCF value of $27.14 a share from the intrinsic valuation side. We also ran a comps analysis using the company's GM, Honda, Volkswagen, Rivian, and Lucid, which really portrays a balanced set of global automakers. And despite improving fundamentals, Ford still trades at a discount on EV to sales and EV to EBITDA. And applying peer medians gives us a comps value of $22.83 a share from the relative valuation side. So weighing both approaches, our target price is $25.42. And with structural improvements, a stronger business mix, revenue growth, better margins, we believe that Ford is meaningfully undervalued. So, Professor Tom, if you don't have this stock, you should add it to your portfolio. I think it's a no-brainer.